The Dow dropped more than 1,100 points. Technology stocks were getting hammered. Bond yields jumped. And yet some of the economic news we were hearing didn't sound terrible.
Jeff, that is a great question because Wednesday gave us a perfect example of how Wall Street can interpret good economic news very differently than the average person does.
Art, I have to tell you, Wednesday was one of those days when I looked at the financial markets and thought, what in the world just happened? The Dow dropped more than 1,100 points. Technology stocks were getting hammered. Bond yields jumped. And yet some of the economic news we were hearing didn't sound terrible. In fact, some of it sounded fairly positive. So how does apparently good news turn into a really bad day for both the stock market and the bond market?
Jeff, that is a great question because Wednesday gave us a perfect example of how Wall Street can interpret good economic news very differently than the average person does. Most people hear that the economy is growing, businesses are investing, and employment remains relatively strong, and they naturally think that's good news. And for the economy itself, it generally is. But investors immediately ask a second question. What does that mean for inflation and interest rates? That is where good economic news can suddenly become bad news for the markets.
So the concern isn't necessarily that the economy is doing poorly. The concern is that it may be doing well enough that the Federal Reserve doesn't feel comfortable lowering interest rates.
Exactly. Investors had been hoping the Federal Reserve might begin opening the door to lower rates. Instead, the Fed held rates steady, and 3 members actually voted to raise them. That caught the market's attention. Think of the Federal Reserve as controlling the thermostat for the economy. Investors were hoping the Fed might begin turning the temperature down by lowering rates. Instead, the Fed essentially said, the room is still too warm, and some of us think we may need to turn the air conditioner up even more. That immediately changed expectations.
And I'm assuming that is where the bond market comes into this.
It is. When investors believe inflation may remain elevated or interest rates may stay higher for longer, they demand a higher return for owning longer-term bonds. That pushes bond prices down and bond yields up. On Wednesday, the yield on the 30-year Treasury moved above 5.2%, reaching levels we haven't seen in many years. And this is very important for homeowners and homebuyers because mortgage rates are influenced much more directly by the bond market than by the stock market. The Federal Reserve did not raise its benchmark rate Wednesday, but the bond market effectively said, we're not convinced inflation is under control, so we want to be paid more to lend money for the long term.
That is an important distinction. People may hear the Fed didn't raise rates and assume mortgage rates should remain unchanged or possibly improve, but the bond market can still move mortgage rates higher.
Absolutely. The Fed controls a very short-term interest rate. Mortgage rates are primarily influenced by longer-term expectations involving inflation, economic growth, government borrowing, and investor demand for mortgage-backed securities. So we can have a day when the Fed does nothing, but Treasury yields and mortgage rates still move because investors have changed their expectations about the future.
Now, there was something else happening Wednesday. Oil prices jumped considerably because of the escalating conflict involving Iran. How does that fit into this?
Higher oil prices add another layer of inflation concern. Oil affects much more than what we pay at the gas pump. It affects transportation, shipping, manufacturing, airline costs, food distribution, plastics, chemicals, and almost everything that has to be moved from one place to another. When oil rises sharply, investors begin worrying that businesses will face higher costs and that consumers will ultimately pay higher prices. That makes it even more difficult for the Federal Reserve to lower interest rates. So once again, something happening thousands of miles away can eventually influence the interest rate a family receives when buying a home here in the Coachella Valley.
And then we had the technology and semiconductor stocks. They've been such a major driver of the market, particularly with all the excitement surrounding artificial intelligence. But suddenly, investors appeared to become nervous.
That's right. A large part of the stock market's recent growth has been driven by a relatively small group of technology and semiconductor companies. Investors have placed enormous expectations on artificial intelligence. They aren't merely expecting these companies to perform well. In many cases, they are expecting extraordinary growth. That means a company can report record revenue or record profits and still see its stock fall if the results don't meet those extremely high expectations. That happened with SK Hynix in South Korea. The company reported tremendous year-over-year growth, but its results fell short of what investors had expected. The stock dropped sharply. South Korea's market experienced a major sell-off, and that fear carried into American semiconductor companies. It was a row of dominoes.
So, we really had three separate forces hitting the market at approximately the same time. The Fed signaling that rates could remain higher for longer, oil prices creating more inflation concerns, and investors questioning whether some AI and semiconductor stocks had simply become too expensive.
That's exactly what happened. None of these concerns were completely new. Inflation has been a concern. The conflict in the Middle East has been a concern. Technology valuations have been a concern. But Wednesday was the day when all three of those slow-burning fires flared up together. And once investors began selling, that selling created even more anxiety.
Now, Art, let me push back on my own reaction. When I saw the Dow down more than 1,100 points, my immediate thought was, this is catastrophic. But is that the right way to look at one difficult day?
Probably not. It was certainly a significant market decline, and we shouldn't dismiss it, but we also need perspective. One of the best questions investors and consumers can ask when they see a scary headline is, down from what? A 2% decline sounds enormous when we look only at that single day, but if the market has experienced substantial gains over a longer period, one sharp decline may simply represent investors taking profits, adjusting expectations, or repricing risk. I like to describe it this way. One day in the market is weather. The longer-term direction is climate. Wednesday was a significant storm. But one storm does not automatically mean the climate has permanently changed.
That may be the most important message because financial headlines tend to make every market move sound like the beginning of the end.
Fear gets attention. Dow plunges more than 1,100 points will always attract more attention than markets give back a portion of their recent gains as investors reconsider inflation and interest rate expectations. But the second headline may provide much better context. The same thing happens with mortgage rates. A consumer hears that rates moved higher one day and assumes the opportunity to purchase a home has disappeared. That is rarely the whole story. The right question isn't simply, what is today's advertised rate? The better question is, what strategy can we build around the buyer's income, available cash, purchase price, timeline, and long-term goals?
So for someone watching this who is thinking about buying, selling, or refinancing, what should they take away from everything that happened Wednesday?
Don't make a major financial decision based on one day's headline. Market volatility may create challenges, but it can also create opportunities. Bond yields can move quickly in either direction. Mortgage rates can improve or worsen before the headlines even explain why. That is why preparation matters. If you are considering purchasing a home, get qualified before the opportunity appears. Let's review your income, credit, available funds, and monthly payment comfort zone now. Then, if the market gives us an opening, we are ready to act rather than beginning the process after everyone else sees the same opportunity.
So don't panic over the weather. Understand the climate, have a strategy, and be prepared when the market gives you an opening. Art, as always, you have taken what felt extremely complicated and made it understandable. For anyone who wants to know what these market movements could mean for their specific home buying or refinancing plans, reach out to Art and the team at MortgageWorks. Art, thanks again.
Thank you, Jeff. And remember, the headline tells you what happened. A well-designed mortgage strategy helps you decide what to do about it.